Hello everyone, welcome to our YouTube channel. And in this video, I will be speaking about monetary policy, RBI's monetary policy, which you often hear it, and about how it impacts Indian stock markets. So in this video, I will give you some glimpse of what it is about. And to be honest, in detail is there is this information is something which I actually had read it myself and then came it to you, because this is a term which you often hear if you are a trader or investor in stock market. So basically, RBI issues this monetary policy, but what exactly is a monetary policy? A monetary policy is basically a macroeconomic policy laid down by the central bank, and it involves management of money supply and interest rate, and is a demand side economic policy used the government. So basically, it is the monetary policy of RBI is aimed at managing the quantity of money in order to meet the requirements of different sectors of the economy in the country, and to increase the pace of economic growth. This is also very important for inflation too. Now, yes, so the objective of the monetary policy includes ensuring inflation targeting, as I told, and price stability, full employment, and stable economic growth. Now, the money supply can be directly affected through reserve ratios or open market operations, and can be indirectly affected by using key interest rates to influence the cost of credit. So some additional information, as you would I already mentioned about the price stability, control expansion of bank credit. So basically, Monetary Policy Committee, RBI, based on the 1934 RBI Act, was amended by Finance Act 2016 to provide for a statutory and institutionalized framework for a committee, and so the Government of India, in consultation with RBI, notified the inflation target in the Gazette. Sorry, I think this is not so important as such. What you need to know here is, these are the instruments which are used to control the money flow in the economy: open market operations, cash reserve ratio, statutory liquidity ratio, bank rate policy, credit ceiling, credit authorization scheme, moral suasion, repo rate, and reverse repo rate. Now, this is a term which you hear from time to time, and repo rate is basically a rate at which RBI lends to its clients against government securities, and reduction in repo rates helps the commercial banks to get money at a cheaper rate. An increase in repo rate discourages the commercial banks to get the money, as the rate increases and becomes expensive. So reverse repo rate is the rate at which RBI borrows money from the commercial banks, and the increase in the repo rate will increase the cost of borrowing and lending of the banks, which will discourage the public to borrow money and will encourage them to deposit. So as the rates are high, the availability of credit and demand decreases, resulting to decrease in inflation. So that's the logic behind it. And this increase in repo rate and reverse repo rate is a symbol of tightening of the policy, and this is how it is basically calculated, and what repo rate means whenever you hear this term, whenever a policy is announced. One additional information: this is basically done once in 2 months as of now, and this could change in future, and so that's the frequency of this policy. All right. So hope you enjoyed this informative video. If you still have any questions or clarifications, feel free to ask in the comment section, and I can put down these 3 links too if you want to read more about it. Thank you, and I will see you again on the next video.